7 years ago, March of 2018, Trump announced tariffs on China. The market dropped 8.5% and the VIX hit 26, and the market bottomed the day after those tariffs took effect. Today, the market is down more than 10% with the VIX touching 28, and it seems like there's a lot more downside to go. But the macro setup from today versus 2018 is much different. Back in 2018, after the first tariffs, that 8.5% correction, the market made a full recovery and made new all-time highs until the conditions looked more like today. Growth and inflation started to roll over and the market completely tanked. The market fell 20%. Until the Fed flipped and then the market ripped. So the moral of the story, the market can't shake a trade war if growth continues to roll over. But we should see a bottom if inflation continues to improve. Even better, the Fed needs to acknowledge the progress on inflation and signal a cut. Therefore, we're unlikely to see a sustainable bottom until the Fed signals a cut. And I wouldn't bet on a full recovery until the Fed actually cuts. It's possible the Fed won't cut until they see how prices react to the April 2nd tariffs. And that means we might not see a cut until May or June. Now, my bet is the Fed wants to see at least 3 declining inflation reports before they make a move. And so far, we have one good report in the books, and we'll see if we get another one at the end of March. The good news is the trade war is very unlikely to cause inflation to spike without oil prices actually spiking, and it doesn't really look like there's a good chance of that actually happening. As a matter of fact, OPEC is set to increase production in April, which puts downward pressure on oil prices. Now, why would they do that? Maybe Trump is putting political pressure, but who really knows? What we do know is lower oil prices eliminate the threat of inflation, which gives more confidence for the Fed to implement a cut. Now, the next question for markets is how bad is the slowdown? Are we looking at a full-blown recession or a dead spot in the business cycle as taxes suck liquidity from the economy, Doge hurts consumer spending, and tariff uncertainty weighs on business expansion? Corporate layoff announcements just spiked to the highest level since the pandemic. The unemployment rate ticked back up, manufacturing employment fell back into recession territory, and the Atlanta Fed GDP estimates for Q1 have pretty much turned negative. The media is pretty much screaming for recession, which pretty much spooks consumers into tightening their wallets. The savings rate should go up and consumer spending should fall. But the fear, uncertainty, and doubt might be exactly what the Trump administration wants to see as they attempt to reset the economy. An economic reset is the methodical approach to get interest rates lower by slowing the economy enough to break inflation while avoiding recession. Now that sounds good, but the market isn't gambling with the avoid recession part, considering the length and magnitude of the trade war is unknown. Now, if people do expect a recession to come, they will slow their spending, inflation will break. But the tricky part is tracking the speed at which the economy slows and knowing when policymakers will actually step in. Now, Trump admits there will be pain and more than half of the market is already rolling over, but the ISM, manufacturing, and services are still in expansion territory, with the ISM employment up for the 3rd month in a row, and the economy grew 150,000 jobs in the month of February. Goldman Sachs and Morgan Stanley have GDP between 1.5 and 1.7%. That's not a recession. But more importantly, the Fed and the Treasury are loaded with stimulus, which makes this much different than the setup from 2018. In 2018, the Fed was actually raising interest rates, and once the economy rolled over, Trump was all out of stimulus because he exhausted the tax cut stimulus earlier in his presidency. But today, Trump has a lot more cards. Tax cuts, deregulation, and good old infrastructure spending. As a matter of fact, the TGA, the government spending account, is fully loaded and just started unleashing fiscal liquidity into the economy. Over $300 billion has already been drained, and that liquidity goes into commercial and regional banks. And what do you know? Bank deposits are on the rise. And what do banks do when they have more deposits? They create more loans. And we see bank credit growth breaking all-time highs all around the time the TGA began to unleash liquidity. And like we talked about before, a slowing economy leads to an increase in liquidity. And a slowing economy is not a recession. Recessions are the result of an unforeseen shock. And if the market were actually concerned about recession, we would be seeing the dollar on the rise as a flight to safety, a safe haven as a world reserve currency. But instead it's falling, and that makes sense because the US money supply is still accelerating. The global money supply is breaking new all-time highs, so more dollars are being created and liquidity is rising. And this is why gold is breaking to new all-time highs. It's not a hedge against consumer inflation. Just look back to 2022. It's a hedge against monetary inflation, meaning gold is predicting the Fed will be forced to cut. We saw the same thing back in 2018 before the Fed actually cut. Gold took off and didn't stop until the Fed signaled tightening. And we have another source of liquidity coming from the bond market. Treasury Secretary Scott Bessent is targeting the 10-year bond yield for a very good reason. As bonds rise, borrowing rates fall, and the demand for credit increases. That's liquidity, all because debt is able to be financed at a lower level. This is exactly why Bessent is so adamant about getting rates lower. Mortgage rates are also tied to the 10-year treasury, so naturally, lower mortgage rates unleash credit into a struggling housing market. The economic slowdown and the fear of recession is literally triggering a cushion of stimulus, and I believe the market will start pricing this in sometime in April. So far, we've covered the US economic reset. But the global economic reset is much bigger. Trump is not just disrupting global trade, he's attempting to restructure the entire global supply chain system. If Trump is able to slow the economy without a recession, forcing the Fed to unleash liquidity, the trade war will basically turn into a financing war. And the US has the most firepower by far. This is the Great Reset. In my view, Trump is forcing an economic siege. In a siege, you surround your enemy's fortress, cut off their supply lines, and allow starvation to set in. They either crack from the inside, starve to death, or surrender. Whoever had the most resources could withstand the siege. But in this case, whoever has the most financing power to avoid recession is likely to come out on top of the trade war. Now, the only country that could go toe-to-toe with the US in a trade war is China, but they've already exhausted most of their stimulus. China cannot afford a full-blown trade war. It would cause a recession at a time when most of their tools are exhausted. As a matter of fact, markets are not even pricing in recession for all of these opposing countries. And that tells me the likelihood of a negotiation is taking place as we speak, or else markets would be pricing in recession. The fact that Trump is changing his mind on tariffs pretty much every day is actually a positive because it shows markets he is negotiable. In a game of chess, you don't want your opponent to understand your next move. So the trade war might actually escalate and de-escalate for the rest of the year because what Trump is trying to pull off is going to take multiple years. Trump wants to establish the US as the global manufacturing powerhouse. He wants the US to be more of an exporter than an importer. And what this does is it lowers the trade deficit, saves money, and protects jobs in America. His strategy is painful in the beginning and rewarding in the end. From Trump's perspective, tariffs solve two problems for America. They reduce the trade deficit, which ultimately leads to reducing the national debt. And they incentivize manufacturing and technology to flood into the US borders. From his perspective, the US can't lose simply because the US is the largest importer in the world, which means it's the largest spender of goods outside of the US. This massive spending is at the same time a revenue stream for other countries who sell their goods to the US. And that revenue feeds their labor markets and their economy. Now, the problem for the US is that expenses are larger than incomes. Exports are income, while imports are expenses. And in terms of trade, expenses are much larger than incomes to the tune of negative $1 trillion a year. Now, Trump blames the existing tariffs put in place against the US, so he's using reciprocal tariffs of equal amount to pressure opposing countries into removing their tariffs. But if other countries don't comply, they will naturally fall into recession much faster than the US, considering they rely significantly more from the US consumer than the US relies on them to grow its GDP. Tariffs simply incentivize companies to move their production lines right back into the US. and that pulls labor and GDP from those other countries. We already have lots of evidence of onshoring and reshoring into the US. So these companies are punished if they stay out of the US, rewarded if they come in, and rewarded again with a tax cut if they move to the US. So as the trade war goes on, there's a huge incentive to move your supply chain into the US, making the US a much bigger manufacturing force than it has been in the past. And yes, that is inflationary, but not if energy prices are tanking, and that's what we're starting to see. So over time, the weaker these economies become, the more desperate they become to make a trade deal. And the more they resist, the more painful the economic siege. Now, one of the catalysts for the market would be the announcement of reciprocal tariff reductions. So Trump believes with the Fed at his back and with more stimulus in the future, he can't lose the trade war. As long as the trade war escalates, the market will corner the Fed into cutting rates. If you enjoyed the content, don't forget to like, subscribe, leave me a comment. Stay blessed.